In this discussion, we will discuss the discussion question of discuss contribution margin, unit contribution margin, and contribution margin ratio. These are going to be some of the major components of the CVP analysis, the cost volume profit analysis, and that's probably where we want to start. We want to start with the idea that these are typically terms and types of calculations related to managerial accounting, related to CVP analysis, related to cost volume profit analysis. These are not types of calculations we typically see on the normal financial statements, on generally accepted accounting principle type financial statements. They're used as tools for managerial accounting. These are going to be some of our major concept tools that we will have for managerial accounting. We could go through, of course, the calculations of them, and then we could discuss more on the components of them if we were to expand in an essay question or in a discussion question type format to pick up as many points as we can. So the contribution margin, that's a good place to start. The contribution margin is going to be the sales amount minus the variable costs. Now, it's important for us to keep in mind and consider and remember these different ratios that are all kind of related. They're similar in fashion, but we want to keep in mind the contribution margin versus the unit contribution margin. And we might see these again in the same kind of format or in the same worksheet, or because once we figure one out, we might want to figure the other out. If we know the unit contribution margin, in other words, and the units that we produce, then we probably want to calculate the contribution margin. And if we know the contribution margin and the units we produced, then we probably want to calculate the unit contribution margin. The contribution margin is the total, so that's going to be our total sales minus our total variable costs. Oftentimes we'll want the unit contribution margin, which is going to be the unit sales price, how much we sell our inventory item for, minus the variable cost, which is going to be the cost per inventory item. And again, if we hold constant, the sales price being constant, the variable cost being constant, then we could figure out what the total price was if we have the unit numbers. We could figure out the unit numbers if we have the total numbers and the number of units. So we could figure both those out, but you want to keep them separate in the mind. And then we have the contribution margin, and you could calculate the contribution margin using either the contribution margin totals or the per unit. In other words, it's going to be the same ratio that we'll have. The ratio that we will be using, we could get to the same number by taking the unit contribution margin divided by the sales, or we could take the total contribution margin divided by the total sales. And so those are going to be basically the calculations. Once you have that down, you might want to go into, the components of the calculations and then the uses of them. The component of the calculation, we got the sales and we got the variable costs. Now, the sales were pretty self-explanatory. We worked with sales before. We know sales from financial accounting. It's basically the revenue line. But the variable costs are a little bit different. So the variable costs, remember, are going to be a term that's going to be specific to the cost volume profit, to the managerial accounting typically. And those are going to be the costs that we break out by behavior. We have to actually go through, break out the costs to the variable cost once it changed with the level of production. And that's going to be how we get to those variable costs. The variable cost per unit then will be a standardized number because we can divide by the number of units to get the variable cost per unit. And so we should be able to get that variable cost per unit. Again, that's a cost volume profit analysis type of number. And what would we use this for? Well, these are our major tools for cost volume profit analysis. The cost volume profit analysis really helps us to project into the future. We're standardizing how things will happen by the behavior of the cost, and that allows us a lot of flexibility to make projections about things that change. So if we have a change in production level or something like that, we could plug that into our worksheet and we can make projections into the future a lot more easily than we could do so if we had just a normal kind of income statement type format. So the projections into the future are usually one of the major things. The decision-making processes, managerial accounting, what if analysis, what kind of things should we do in the future, is what this tool will be, because it's going to be a component of the cost volume profit CVP analysis, and that's going to be one of the primary functions of that analysis.